All right, good evening, ladies and gentlemen. This is Clueless Day Trading Frank. This is, I believe, an important ACS coaching session. We will have people coming in at times. It is, after all, the day after July 4th and on a Wednesday. And people will be coming in as they can. Okay. Session will be recorded. It is approximately 7:34 p.m. Eastern Standard Time, July 5th, 2017. The recorded ACS webinar will be uploaded to the YouTube channel and will be available to paid ACS students. Their emails will be put in there and the link will be sent to them, so you can always review it at your own time. Full disclosure, this is purely for financial education and not for any solicitation or advice. We have Brian, a brand new free trial subscriber, and hopefully a committed member soon. We have House. We have Jay Fox, a recent member. We have MW, a terrific recent member, who actually reminded me that I had an ACS session today. Thank you. And we shall begin. So tonight's topic is going to be very relevant to what is happening right now, and we are not going to get too much into the intricate details of technical analysis, but I'm going to show you some very simple way of gauging where the markets are, what they're doing, where they're going, so that you can manage your trades in a more efficient manner. So a couple of broad points that I want to cover. I will leave the last part of the session for Q&A, and I'm happy to answer any questions that you ask in the fullest of my abilities. So let's start off with a couple of general but important statements on the overall market. The markets are, when I look at it from a broader perspective, are just fine. We have sector rotations, we have heavy volatility, we have sudden drops in the market, from being up 50 to down 50, so that's a 100-point swing. We have news flashes, what we call news bombs, in the old days on Wall Street, where domestic or international news events, terrorist events, North Korean missile launches, you name it, Trump tweets, all kinds of stuff that's that affect the market on a daily basis. We call that noise. Noise is important because we cannot run away from it, and that affects on our that had a direct effect on our P&L on a intraday basis. And trades can go upside down. But when I look at the broader picture of the markets and multiple charts that I've posted, which is a very important reminder that I want to make, do study all the charts that I put out. I cannot physically put out all the updated charts. It's not humanly possible. But I do put out some relevant charts which I think are very important in your effective trade management. I'm going to coin a term, ETM, all right? Because effective trade management, when you have an eye on the bigger picture, is so critical. So you don't do stupid things like sell out and at the wrong times, or and the wrong times can mean sell out for a loss or for a minimal gain, but you stick with the trade. Now, saying all that, these are, and this is not just the first time, this has happened so many times over the past 2 years. It's almost like a broken record. When the markets are consolidating within a band, and you can see that right there, you can see that. It's all visual. You do not need to be a technical scientist. You do not need to look at every single indicator and stuff like that that I'm putting through or that's out there. When the markets are basically trading in a band after a climactic drop, you have to know, as I clearly show with all the lines, and we're going to go through all that in very simple terms. that whether we are truly damaged, or is it a gunshot wound to the shoulder? I hate saying that type of stuff, right? But I'm a New York guy. What can you say? So, or is it something much more fatal? Traders in general are fatalistic. They just, they want to believe that things are in general. They want to believe that the world is falling apart, and that we cannot, we can't keep on moving higher. It's just not possible. Well, it is possible. It is possible because I have seen it happen. I have been there. I was on Wall Street on March 9, 2009, when the S&P 500 was 666, 667, the devil's number. And we are where right now? We're at 2432 after hitting a high of close to 2457. Now remember what you're seeing behind you. You're seeing the guts of the market, the real deal. That's the reason why I showed this chart. That's called the futures. Now we're not trading futures on the real-time Twitter feed on Clueless Say Trading. I have traded futures, and I intend to basically go back to it again. But I use the futures as a proxy for what the real market is doing. Now, if I was trading futures all night, then you guys wouldn't see me during the daytime, in which case you guys would be pretty lost. So I'd rather get some sleep and keep my good looks than trade futures, from 6 p.m. To 8 a.m. in the morning, which is a very profitable venture for many, many futures traders. So the S&P 500, the SPX, hit 2453.82. Let's round it off, 2454. So the bottom line is that what I'm showing is the climactic drop on, and this was on the 29th, which I believe was Thursday, right? Yeah, it was Thursday, where we had a nice ramp up and then a sudden climactic drop on the markets, primarily propagated by a massive sell program. And I mean massive. These are billions of dollars. Billions, okay? On the tech side. And I believe that day we made a crap load of money on Goldman Sachs calls because financials went the other way. That is the bifurcated market that we trade in. So if you come in with the illusion as a trader that just because the Dow Jones is up and everything is going to be all peachy, then you are in a delusional state, which I always, as I preach, you cannot be. The markets are extremely bifurcated. They are volatile, and sectors move on their own merit. Days you're going to have the tech side of the market, the Amazons, the Netflixes, the Teslas. Tesla had a bad day today, right? Yeah. So and we're going to go through that too. And the price lines and stuff going higher, you could have the biotechs all down. Or you could have the biotech sector. And we have our favorite stocks that we trade, the Regenerons, the Clovises, CLVS, SRPT, PBYI, and a bunch of them. We trade the IBB at times, which is the overall index. So it's a bifurcated market where sector rotations happen in an instance. Now, in the old days, it used to be more correlated, and things, big moves happened over a whole bunch of days, if not weeks. All those are condensed now. And this is very important stuff, because once you guys grasp this as reality, you're going to be fine with the markets. When you find a big volatile moves in the market as a abnormal occurrence, you're not going to be fine. This is the new normal. And the new normal is wide swings or tight range trading. And that's what I try to my best, as you all know, to show every single day, every single week. So I'm kind of resigned to the fact, and I have accepted, I'm no longer in denial stage, and I haven't been for a while now, that the volatility is here to stay. So because I'm not in denial, my ROI percentage, return on investments on a particular trade, and my performance exceeds many others because I've accepted the fact, what my dad always used to tell me, God bless his soul, passed away many years ago, that life is tough. So if you accept that it is tough, then everything else you do is easy. If you think it's one easy ride, and never forget, we're not some Saudi billionaires, like I love saying, or some Chinese billionaire magnate, or some American landed soul who got a gold or silver spoon stuck down their throat. We're all hard-working traders. We are all different levels. We're working hard. We have a purpose, and the purpose has to be greater than just a trading profit. You have to have a purpose why you're doing this thing. Is it for your family? Is it for yourself? Is it for your, it has to be a higher purpose than just pure numbers. So saying all that, let's dive into the technicals. And I'm going to sporadically come in and explain to you a bunch of stuff that's going on. So that happened, and let me just get my favorite pen. That happened, all right, this is something that would happen in weeks, except it happened in 3 hours. Okay, was the consequence of a very, very large reallocation that happened within some hedge funds and large asset allocators. And asset allocators simply mean mutual funds, which are the 800-pound gorilla in the business. I come from that genre. My first job was at Putnam Investments in Boston, right out of college. Worked as a peon analyst, which simply meant I parked my boss's car, got him coffee, and learned every aspect of the business and rose to the higher ranks before I joined Wall Street down the road, which was 3 years down the road. So the point is, understand the money management aspect of the business very, very well. And let me just clue you in a very simple fact. They're not that smart. They're a bunch of heavy-duty lemmings who, in many cases, simply react to the markets. They do not predict the markets. At Clueless 8 Trading, I am proud to say we do predictive forecasts which are correct 90% of the time, if not more. And anyone who's been with us for more than 6 months knows that extremely well, and I will stand by it. It is not easy to do predictive forecasts, especially in volatile markets, but I do it every single day and every single week. So with all humility, that is something that I want all of you to understand, what I'm trying to message through on my charts, and then we can move from there. Is that fair enough? You guys understand what I'm saying? Yes?
Yes.
Good.
With you.
All right, good. So bottom line is this happened because there was a massive sell program where there was reallocation going on. The allocators, the mutual funds, some institutional funds said, you know what, we're up a gazillion points because, on the Amazons, the Pricelines, the you name it, the Googles. So we're going to basically take some profits off the table. We're going to shove into the banks and the financials because rates are going higher. Great for banks. The Goldman Sachs, don't forget, last Friday, it was up almost 400+% on the calls that we bought prior to that. Okay? So bottom line is that, and we were up on Amazon too. And I told people straight out, and if you look at my alerts, it's very important. When I'm putting out an alert, I'm selling 70%, and that's basically the signal, okay, or 80% of my trading positions. That primarily means, what's the trading position? A high beta moving position, not the swing positions. The swing positions work out. Look at Clovis, up a gazillion points over the last couple of weeks. CLVS. Regeneron, we bought from the lows. Allergan, we bought from the lows. PBYI, Puma Biotech, still running with it after the big pop-up. Sarepta, slow but rising. Those are swing positions. AKBA. Okay, so I'm not talking, when I'm saying 70 to 80% of selling the thing, I'm talking about the high beta movers. I'm talking about the Amazons. I'm talking about the Teslas. I'm talking about Google. So that has to be clear with everyone, and they should be clear about it because, you know, it's pretty obvious. So Goldman Sachs is kind of a hybrid. It's a hybrid between a swing and a short, and there's a little bit of noise coming from someone. There's a little bit of noise. Can somebody mute? Okay, that's fine. So this is the signal, because I can't alert every trade that I'm selling. My book is fluid. I'm not a crazy day trader, but at the same time, if I have a nice bunch of contracts, or even a small bunch of contracts which are up 100, 200%, which occurs all the time in our service, then obviously I'm going to take down some nice fat profits and run with a small, small bunch. So you have to, and one of the ways that I don't have to, the reason I don't have to constantly alert people, because my charts are very clear as to what my levels are. And you have to adapt to where, if it's getting close to it, if it's suddenly moving the other way, then you obviously have to adapt to it. That's the reason why I spend so much time and energy on producing these charts on a real-time basis, which is not an easy feat. And if you don't believe it, try doing it yourself. I'll tell you, it's, and putting it out there, because I could put a chart at 8:30, I could put a chart at 1:30 and at 3:30, which would be fine, right? People wouldn't complain. But I do care about how you guys, are understanding the market. So I'm putting it almost every half hour. It's not that you need to say, oh, thank you. I don't need thank yous. I need you guys to basically focus and do what you need to do. There is no other service out there. And I was talking to a great individual today, who's here today, and I'll mention the name, Brian, who's going to be a new member hopefully soon. And we're discussing this stuff. And the reality is that if you really want to understand the guts of what's happening on the market in a real time and a longer term basis, there's no other service that puts this visual aspect in front of you, because a picture speaks 1,000 words. So if you have time and you are, then you got to look at your own screens too. So I hope I'm clear on that, because I know you guys understand that. It's pretty straightforward. So saying all that, we're going to focus on this one particular chart, and then we'll look at Thinkorswim. We'll look at two other things. It's not the quantity, it's the quality that counts. So what we're doing right now, after this drop, this massive sell program, and then the subsequent drop here, if you notice, late in the day, starting at 340, that was a leftover drop. Here was another leftover drop that happened on the 3rd, right before July 4th, on Monday. These were the leftover margin sellouts that need to occur, and all because of the tech blowout. Now, bear with me one quick second. I'll be back in about 30 seconds. Please look at this chart. I just have to take this phone call. I'm back. I hope you got a chance to absorb this this beautiful piece of art. But let me get into it. Is everyone on board? Yes?
Yes.
Yes.
All right, that's great. That's good. Sorry about the slight delay. Had to take this call from the White House. Had to tell them what they need to do instead of doing stupid stuff. Okay. So let me just go over this in very simple terms. All right. So this big drop, gave you the reasons. This big massive sell programs. No kidding. Friday afternoon at 3:30, everything that I talk about was explained by Tom McClellan. That's a McClellan oscillator. His father was the one who invented the McClellan oscillator, one of the most important and critical tools. And we'll see that on the Thinkorswim charts in a few minutes, that I've used in several times during extreme market conditions, which has proved to be extremely profitable. McClellan oscillator, deep oversold, minus 200, minus 300. All of you should have seen that. And I said buy, because that's what happens. Because 24 to 48 hours, call it 24 hours, you get a big reflex bounce. Reflex bounces, okay, similar to this, generate significant amounts of money. So anyway, he said the same thing. He said there was a big sell program and they need to basically wash out that stuff. They didn't have enough time, so they did it here, this move. They did it here, this move, and then finally they got done with it on July 3rd, right before July 4th, Independence Day, holiday. And guess what happened to text today? Do I need to remind you? Amazon was up 21, ended up 18. Google was up after the first short that we did, which generated from $3 to $8. The July 7th, 920 calls, puts. Very simple. At that point, you buy. So the Google was up 15, well, after being up higher. Apple was up almost $2 from those lows. Priceline was up 24. That's what happens after the selling pressure abates. That's just the way technical trading works. Because after all, Why do markets go up? There are more buyers. Why do markets go down? There are more sellers. Now the difference is, in the old days, as I like to point out to everyone, it was humans who did it. Except now, humans program, very smart humans program black boxes, which are high-frequency algorithmic trading platforms, programs, which do the job for them, except they do it in minutes or seconds. Well, minutes and hours. The reversals happen in seconds. You guys all know that. So if you're just kind of wandering in and say, oh, I'm going to buy that because you said buy it, well, you might have missed a good portion of that trade for that particular day. So I want to be very clear about that. So let's say I alert on buying the SPX calls at pivotal lows. That reversal took possibly 20 minutes and that double barrel move on the 5th. Okay, today's the 5th, right, guys? Yes? So those ones went from a low of 450. So let's say you kind of like, you were timely, you were watching, you were focusing. You got in like 5 because they move fast. They went to close to $9. And I, no make a story, that's just the way it works. And it wasn't even that volatile a day. It was a very tight range trading day. Because if it really, if the market really went up into the second channel, because this is channel 1, this is channel 2, and there's a channel 3 up there. So it was still good for 80+% on your money. Where the heck else do you get 80% on your money? Doesn't matter what size you're putting in. And if somebody was fast enough to buy the 450, 460, 470 level, then you made 90% on your money or more. So that's what I'm talking about. That if you're just wandering in and saying, oh, la-di-da, I'm going to just buy the market, he's shown the charts, you're doing that, well, you're probably not going to make money that day. Got to be within a time frame where you're buying it here. And everything is drawn here. So it doesn't mean we're just going to bust a move here. Yeah, we'll bust a move here once the tensions in North Korea, once we get some sort of positive announcement on the tax bill, tax reform, and the healthcare bill, which everyone seems to be they've kind of shut up about it. But the markets really don't care about it. Because, well, we're going to talk about that. That's the political game theory aspect of it. Everyone thinks this market's destroyed if we don't get a new healthcare bill or we don't get tax reform. Wrong. The markets know better. The markets went from 666 on the S&P 500 to 2,200 or so, or 2,000 plus. Prior to the Trump win. And I'm a hardcore Republican, so don't take me the wrong way, all right? I'm all about business. I'm not about personalities. I'm about business and capitalism. The markets went from 666 to 2,000 plus. Do the math, all right? Under no tax reform. Under ACA. Or Obamacare, as they call it. So what gives? You think the markets really care? Have you ever thought about it like that? Of course the Trump policies are very business friendly. I'm all for it. Tax reform is important. Corporate tax reform. We have the highest corporate tax rates in the world. I'm not talking about just tax reform for, the top 1%. Okay? So because of none of this happened and the markets went up a gazillion percentage points. Priceline went from a $600 stock to being a $1,900 stock. So you think the markets really care whether it's Republicans and Democrats? Market cares about corporate profits. And if a company is delivering the profits, it shall go up. And that is the eighth commandment. How about that of markets? All right. Because they follow the money, and the money is if a company is delivering the goods or not. All the political stuff on the sidelines helps, but it doesn't derail the markets. Am I clear on that? Yes? No? Did anyone? Yeah? I mean, you don't have to agree with me,
Yes.
but I'm just, like I said, I'm not about agreement. I'm just telling you my thoughts. So don't think the markets are going to be all in a bear market because both houses of Congress and Senate couldn't pass the health care bill, or they couldn't pass the tax bill. Yes, there are short-term reactions. That's going to happen. But it's not going to be a long-term fallout. As long as global growth and the finest companies in our country which deliver the growth, because remember, 60+%, 70% of the U.S. economy's growth and basically corporate growth, does it come from the U.S. or overseas? Can somebody answer that? Could somebody answer that? Where does the majority of our corporate growth and the profits come from? Domestic or international?
Domestic.
Nope. Completely wrong. Where does the big money profits come from in the U.S. on corporates? Domestic? I'm not talking about GDP. I'm talking about actual corporate profit growth. Can somebody answer that? International, Brian. Brian says international. So you're absolutely correct. Shut off global exports and put out all kinds of stupid. I have a lot of dogs, so I understand that part. So shut off, like, all kinds of, put up all kinds of protectionist measures. Shut out the rest of the world. Our markets are going to be down 50%, guaranteed. And you can't even come close to what I'm saying. Trust me when I'm saying that. Not being jingoistic. I'm not being political. I'm just giving you hardcore business facts. GE can't sell its turbines in some third world country or in China. Raytheon and Boeing can sell their planes and their arms, their weapon systems and their fighter planes overseas. Good luck. You can sit here and twiddle your thumb and keep on saying, oh yeah, we can just survive on our own. We cannot. It's a globalized economy. And it doesn't mean that you leave the rest of the American workers on the side, but that's just the way it is. So let's move on. The bottom line is that we are trading in a band here. I've shown this repeatedly. That band is 2432 and the low end is 2417. That is roughly 15 points. Can somebody tell me, as I always ask in almost every ACS, 15 S&P points, the band that we are trading in right now, right? Roughly 15, call it 16 S&P points. Or if you want to widen it, why don't we widen it here to this spike that we got on the 3rd, which we sold into on the SPX. Beautiful profits. Okay, from down here on Thursday. So let's call this the band, not this one. So 2437 and 2418. So we're talking about 19 points. Let's call it 20 points, just for argument's sake. So what's 20 S&P handles or E-mini handles for the Dow? Somebody venture out and tell me.
100 to 120.
There you go.
100. Yeah.
Okay, perfect. Thank you for the answers. So we are trading in a band of roughly 100 to 120, maybe a little bit more. But I use a factor, and Brian, you should know this. You use a factor of roughly 6 to 7 points for the S&P versus the Dow Jones Industrial Average. Because whether we like it or not, yeah, I know as traders we focus on the SPX and the E-minis and all that stuff. But deep down in our head, the little, kitty self says, where's the Dow? Where's the Dow? Am I right? Am I right on that? I mean, really, when you think about it, is the market up 100? Is the market up 200? Well, it's not the S&P, because if the S&P was up 100, that means we would be up 700 points in the Dow in one day, which we have never done, and I don't think we'll ever do. For a while. So yeah, 100 to 120 points is roughly. You're talking about. That's 100 Dow points. I was almost converting it back to S&Ps. So this is the range we're trading in. But the range trading on the indices it can have amplified effects on individual stocks. We had some big winners on a couple of I call them supplementary positions, right? That I put out. But you guys need to focus on that. Time to time, I'll say buy EOG, the energy, which was down today, but delivered us close to 90% over the past couple of days. I'll talk about Boeing, BA. Time to time, you will see me come in with CSX. I alerted American Airlines today. These are lottos. The options on these babies are not a gazillion dollars. You don't have to fork out everything you have in your wallet to buy a call on Amazon and Priceline. Priceline, forget it. You got to sell half your house to buy a decent amount of calls. Yes, they give you the 100, 200%, but you still have to lop in a good portion of your risk options trading capital in order to buy them. But with these babies, with BAC being one of my best and ultimate trading stocks, you can buy the lottos. Brian, you're new, so let's tell you something. We bought BAC calls at 14 cents, as low as 6 cents. This was just within the past 10 days. We sold them close to $1. In my case, 70 cents, 80 cents, with, let's call it $1. Do the math. Okay? Just do the math, which I'm doing. You're talking about 600 to 700% on your money. I mean, that's not a joke, and that's a reality. It's not the first time we did that. So BAC calls lottos. What are lottos? Lottos are simply cheaper options, sometimes that expire within the same day, which is the Friday lottos we play, which is different than just overall lottos, or just cheap calls, which are less than $2. So you have all these different ideas that I put out, and you can trade them nicely over a couple of days. In the case of not Bank of America, BA Boeing, we did it in 3 stages. And I know there are a lot of invisible members of Clueless A Trading who are never in the chat room, who are never out there. We have roughly 150 to 200 members. Most of them are invisible. They're making money. They're just going on. I don't hear from them. A lot of them, they're just doing their stuff. And then I have the active members that I love interacting with. Okay? So the bottom line is, I'm sure a lot of them are buying a whole bunch of this stuff. BAC calls, you could have bought them at $1.40. When I first alerted, they went to $8. So do you wait around till $8? No, you take the $1.40 to 3 to 4. And then you roll them out. Then I originally alerted the 195s and the 200. Where's BA today? Boeing, 202, up $3. The 200 calls are at up 254%. Gotta always focus on the numbers because that's what gets you going. You gotta be hungry in this business. You can't be just sitting around saying, well, Prince Abdul Salam, whatever, is going to, send you a check for like $900,000 because he likes your face. No, you got to fight for it. They closed at 68 cents. I alerted them last week. They went to $2.41. That's a gain of 250%. Those are the ones expiring 7. So let's say you want to buy the swing, which I alerted too, because I said BSE was going to hit a new high. It hasn't even close to hit a new high. It will. I mean, not BSE. BSE will too, Bank of America. I'm talking about, I'm looking at my other screen. Boeing. They went from $1.57 to $3.22. That's good enough for 100%. So you all have to focus on all the other stuff too. Here is the most important thing. And I'm going to try to write this with my lovely Logitech mouse. You cannot, and write this down. This clueless A trading. What's the word I'm looking for? This is the rule. You cannot overload. You cannot overload. Doesn't matter how good the charts look. You cannot overload in, somebody fill in the blanks, in what? Somebody tell me what I'm going to write next. You cannot overload in what? Somebody
any position.
I'm looking for numbers. You're close. You gave the right answer. House said any one position. Brian? Okay, so I'm going to say any 1 to 2 positions. How about that? We cannot do that. I know my charts can work like magic. The only way you can overload, so everyone get that, you cannot. This is the cardinal rule in trading. You cannot overload in 1 to 2 positions because that POS will turn into POS, okay? So when I hear from the traders, oh man, he's smacked because he said he was so hot on Tesla. Yes, I was hot on Tesla and I made money on Tesla. And net, I'm still up based on my previous trades. But if you put all your thing and said, okay, this Elon is going to take you to the moon, well, he is going to take you to the moon, except he's going to shove your face on the ground first before he does that. That's life. It'll turn into a piece of you-know-what. Cannot overload in 1 to 2 positions. It doesn't matter how small the money you have. You can always, and believe me, I have beta accounts that I have small amounts just to test how small accounts can grow into larger numbers. I'm talking 300-400% in a matter of 1 to 2 weeks, if not less. And I'm beta testing those accounts, and they are very successful. Because those accounts, even if they blow up, don't mean a hill of beans to me. But I'm doing it so I can show it to people. How you can take a $300-400 account and turn it into $3,000, $4,000 based on my alerts. And many have done it here. It's not like impossible. But I'll show it the way I did it. So bottom line is, okay, so we got that clear. And this is the trade management stuff. We can be in 1 to 2 position. The other thing you got to do is you got to, you have to basically recycle the money. So a lot of people say, for example, hey, I don't have a day trading account, which is understandable, because it has to be 25,000 or over. So what can I do? Well, You can buy one contract of something, two contracts. It's all about percentages. So you always have some cash on the side. And if you're just going to lump it into one, this is what I was going to get to before I lost my thought. Let me ask everyone this question. What do you think is one of the ultimate option trades or asset classes that can generate anywhere from 60 to 200%, and you can actually overload on them? Can somebody tell me what asset class that might be?
I don't know.
I'll give you a hint. It's an asset class which I already gave you the answer. It's an asset class. What does that mean? And these are the realities of trading that I learned through hard work over all these years. Okay? And when I say an asset class, it's not an individual stock. So right there is the answer.
So the indices,
That is correct. Who gave that answer?
Jason.
All right, Jason, you hit it. You hit it. The cleanest way you can trade very volatile markets, if you don't want to deal with the the BS of whether Tesla's down, because Goldman, we're going to cover that in a minute. Goldman reduced the price target to 180. Can somebody tell me, and I did post that, what they reduced the price target from? How's already answered the question? 190. Whoopee! They just reduced the price target by $10 because they're always bearish on Tesla since it was a $180 stock or $200 stock. So somebody might scratch their head and say, what the heck? The stock dropped 7.8%. Remember, 8% is the number, right? It's always a lucky number. So, and the stock dropped 25 points on a 10-point downgrade. It's not that. There's more to it. And we're going to look at the Tesla chart in a second. And then the Guggenheim upgrade to 430 never got mentioned. You think there's manipulation in the market? Really? Do you think there's manipulation in the market? Heavy manipulation in the market. All right? And the big boys do it all the time. It's just the way life is. We can't change it. Worked on Wall Street for 14 years. I've seen enough manipulation to basically make you guys gag and write a book. But why bother? That's life. So the asset class, as Jody correctly pointed out, are the indices, the SPX, the SPY, which is the derivative of the SPX, the RUT, IWM, the derivative of the Russell 2000, the NDX, and the derivative of that is the QQQ, which everyone hated till 2 days ago or a day ago, and now whoopee, you can't wait to buy like the Amazons and the Pricelines and all that good stuff, right? So the bottom line is that if you want to play the purest form of an overload, you have to play the indices, because indices will move regardless of individual news stories. The individual risk that you have on a particular stock, Tesla is a prime example. Okay, the Goldman downgrade and all that stuff. And the fact that they didn't have enough batteries production to meet up with demand. A normal person would say, what's the big deal? They don't have enough frigging batteries to put in their high demand cars. But Wall Street and stocks are not about rationality. It's about irrationality and emotions. Like, oh, they can't produce. It's a good problem to have, in my opinion, if you're looking longer term. And believe me, I am no big-time Tesla bull. Like I tell many people, including Brian when I've spoken to him today, I don't even give a crap about Tesla. I've never driven a Tesla. I have no desire to drive a Tesla. Give me an Aston Martin DB9. I'll drive it all day long. Okay? Give me all the cars that we have. I'll drive them all day long. They're all gas guzzlers. Long live U.S. oil. Okay? So that's the way it is. But I'm just talking just in general. So bottom line is that if you want to play overload, you got to play the indices. All right? Because those are more clearer in their directional bets. The Russell is the most volatile. The QQQ is in the middle, and the SPY is the more linear one. The Russell 2000 moves in 10 plus points. The S&P moves anywhere from 5 to 6. The QQQs, generally speaking, move on an extreme basis between 1 to 2. Am I clear on that? Now, I mean, this is real trade stuff that I'm talking about before I go back to the charts. So if anyone has any quick questions, feel free to ask me, please. Anyone? Brian? House? Jason? Anyone there?
Nothing here, Frank.
Okay. Jody?
What about the Dow, DIA?
You know, that's a good point. I have played the Dow maybe 3 times this year. I should think about playing it more, but I'd like to play it during really, we did very well in the first trade on the Dow. It was like 100% type of thing. I will reintroduce that back. Okay, Jody?
Okay.
Yeah, they just don't move that much. That's the problem.
Okay.
And you know why they don't move that much? Not because the Dow's not moving that much. It's because there are not enough participants. Remember, an ETF on a particular index moves because there are more participants. Do you understand what I'm saying?
Yes, I do.
Yeah, it's a business, right? I mean, ETFs are like a one real scammy business, if you ask me. And I sold enough ETFs back on my days on Wall Street to know that. And I never sold the crappy ones. And they said, we don't like it when you're selling. I said, I don't care. I don't want to sell garbage to my clients. All right? But just in general, that's it. But I'll certainly introduce that. And they're cheap. They're pretty cheap, the DIA calls and puts. Waiting on the Tesla chart, House said. Okay, so let me go over this quickly. So here's the band we're trading in. It can get very volatile in individual stocks, but so far, as you can clearly see, we are still within the band. And it is very possible that this band can resolve itself to the downside, which means we're going to drop a good 80, 90, 100 points, or we can resolve to the upside, which would be, and I can't tell yet, just so you know, okay? Because it's still within a very tight band. So the upside band would be like this. Remember, this is channel 1, this green line, channel 2, channel 3. Channel 3 is way up on the upside, and it certainly can happen. Believe me when I can tell. Believe me, I've seen enough, and yes, it can. If banks start to move bigger, Goldman Sachs, for example, goes to 232. That's $5 from here. Remember, it was up almost $7 on Friday. I mean, on Monday. So that's big, and it was still up today. We can easily get up there. That's a big fat 400% or more on your SPX calls. Now, you can't do it in one shot. That's another thing I want to remind people, because along the way, there are things to contend with. They are called resistances. They are called little zigzags. So there's no guarantee we're going to get up there, but my other charts clearly show, based on the internals, which I'm not showing here because I'm just showing chart patterns, whether or not something is going to go higher or whether it's going to go lower. So you have to focus on the charts, stochastics, and everything that I put out there. This was a major sell point back on the 3rd, day before July 4th, Independence Day, and I expect that that's going to be major resistance again. So it's very clear on that. Keep on focusing on this. Keep on focusing on the lines that I draw. They're pretty easy to understand. And if you're managing your trades on the other side, or if you're playing the clean SPX calls or the SPY calls or puts, be aware of each one of these lines. Am I clear on that? And I would love to answer any question you guys have. House said QQQ. Okay. So let's change this and see if I have the QQQ chart, which I should. So many. I even have AMD. I never trade that friggin' little stock. Okay, hold on. So ES channel, QQQ, where is Q? I don't see the lovely Q. So we shall devise one. We should create one right in real time. I'm going to save this. So get it? So this is clear. This, by the way, just so you guys all know, is a this is still a bear flag kinda. So if we break out over this, that I keep on saying, that's when the bear flag is negated. In fact, over 2437 on the E-minis. You gotta start tracking this. This is not a joke. All right, gotta start tracking. It's not that hard. This is the real nitty-gritty. What really happens behind the scenes. Remember, everything happens behind the scenes. So the E-minis are basically your way and my way, at least, of knowing what is about to happen. So please try to track it. So let's do the Qs. Q, Q, Q. I know I had it there. I know it's on my other platforms, but and remember, the Qs are what the NASDAQ ETFs are. I believe come earnings, the Qs are going to fly. I think the tech companies, most of them will have phenomenal earnings. But I'd like the market to stay down kind of here so that we have a lot of negativity. Remember, negativity is like a coiled spring. The more depressed you get, the better off you are in buying something. So here's the Qs. We're going to construct this chart right in real time. Let's make this a little bit thicker. There you go. Can somebody tell me what's the next line that I'm going to draw? Somebody tell me where I'm going to take this line and where I'm going to draw it. Does somebody spot something within the vicinity of, I'm giving a hint here. Here, that is the next possible retracement level.
140.
No, what are we looking at? 140? No, I'm talking on the downside first.
Oh, downside, okay.
Yeah. If you look carefully, you'll see. Like I said, the clues are always hidden within the charts. And I'm going to show you real chart construction right now.
132.50.
Why?
In the gap.
Thank you. Holy cow. I'm out of business there. Whose dog is that? I love it. Whose dog is that?
That's mine. MW's.
Oh, love it. What kind of dog?
Sorry.
Huh?
Not sure.
I know.
Border Collie mix.
Love it. We have five.
Rescue.
We have 5 rescues in the house. All right. So in between all my tough trader stuff,
Yeah.
we have 5. We have two dogs and 3 cats. One is a Sheltie Corgi mix. So he's like a low slung collie.
Wow.
Yeah, Sheltie. You know. So
Yeah.
that's how I could tell. Anyway, we'll talk about dog stuff later. But I love that. The fact that you rescued. We're big in the rescue thing. I'm trying to rescue traders. I mean, you know how it goes. All right. So let's.
Thank you for that.
So let's do this. So yes, there's a gap. There's your gap. So right there is your is what we're looking at as from a standpoint of understanding that if things go a little bit more topsy-turvy with the tech side, let's say Amazon comes out and said they sell one less whatever, you know, boy, the markets are going to react like, oh my God, that's the end of Amazon. So that gap most probably can be filled. However, prior to that, we're going to draw another line, pure chart construction, And believe me, all these points are going to be met. And people who have been with us know exactly what I'm talking about. So there you go. And we're going to put this as a, okay. So when they're crying, you know, when the media is like all over, like, oh my God, this is the end of the world, it can never end. Well, this is what you should be looking at. One second. And this applies to every one of the tech stocks that we trade. If Apple comes out and says, oh, we have a shortage of chips for the iPhone 8, you think the market's going to look at it as a positive or negative? It's going to look at it as a negative immediately and then say, oh my God, they must have a huge amount of demand. That's why they can't keep up with the chip orders. Okay, from TSM, Taiwan Semiconductor, or what's the other one that they make all the chips from? Honghai or whatever, from China. That's just what the markets do. So so let's put this on a tactical, technical basis to see. So this is a large consolidation triangle. If somebody's just looking at the pattern, it's negative. Somebody's structuring it, it's not as negative. It's just the way, you know, these things work in the business. So if somebody's like looking for absolute returns, oh, it's definitely going to go higher or definitely going to go lower, they are not going to make money. You got to trade the ranges, period. Okay? And it's the same thing with the market. So I'm doing this here. Now, this stuff can be boring for people who don't really care about charts and stuff, but it's not boring for me because you actually make money on it. So let's look at it here. So the worst case scenario is that we drop down to 132, which is quite a bit of a drop. In the meantime, we have a short-term powerful floor exactly where we are. That's the reason why I pointed the cues out as a short-term tactical trade on Monday. I keep thinking Friday, but Monday was basically like a Friday. So so there we are. Now what do you think your upside is? Your upside is pretty much here. That was the last high. If the bears look at this chart, what are they going to say? It's a what? Anyone guess? What does this pattern look like?
Head and shoulders.
That's correct. That's
Head and
correct.
shoulders.
Yes,
Yeah.
you guys, that's it. I'm not doing any more session. I'm going to have you guys do it so I can sit back, have a nice beer on my patio. I'm serious, all right? Because you guys are good. Seriously. You're dead right. It's a head and shoulders. And it is at this point a head and shoulders. You can still make money within a head and shoulders because if we get a nice sizable bounce, it's going to bounce here. That's going to create the right shoulder. This is in effect the right shoulder here. Right there. So this would be there was never a left shoulder per se, but the upper end of the channel, somewhere between a little less than 139 and change to 140, you can make some decent money on this reflex bounce. You don't have to wait for absolutes, like, oh my God, it's going to definitely go up here and rip higher. I don't believe any of this stuff. I'm more of a market agnostic at these levels. Short-term bullish, intermediate term, I think the market's going to roll down. I could be dead wrong. I've been wrong on my shorts like months ago on a few shorts that I did, and I put a little bit too much money. I got clobbered. Of course, I reacted quickly, but hey, I'm the first one to say. Can't lump on one side or another. So different patterns for different people. Somebody will say, hey, this is a what? What's this pattern? This is a dragon bullish, i.e. a W pattern. What if one of these big boys come out, and somebody pointed out today that overall, between the few companies that are reported for the second quarter results, which are coming out starting now, they've all been great. Even Nike is a great winner. $1.50 calls went to almost 7. Okay, should have bought a whole lump, bought a little bit, bought a bunch of common. Still was a great day. So if they are, and this is the other thing that I actually thought CNBC was smart about mentioning. Did anyone hear this? The number of, which I kind of know, but they reiterated that, number of earnings more, sorry, kind of mincing my words. Hold on. ER, like I call it, ER warnings. Has anyone heard any companies warn about their quarter yet? Not that it's not going to happen, but so far they are by SEC mandate have to warn 2 weeks or at least 2 weeks prior to their earnings. Has anyone heard any big warnings from any one of the companies yet?
No.
There you go. So we just have 1 week here, guys. We have 1 week, which is, in my opinion, a kind of a nervous week where if we hear any ER warnings from any one of the big behemoths on the tech side, I can assure you this gap is going to get filled and this downtrend line is going to be engaged, not broken, but engaged very quickly. Am I clear on that?
Yes.
Exactly. Because this can be construed as a dragon bullish, which is a W formation, or it can be construed as a dragon bullish from this point, which means the gap has to be engaged. Now, some people who are big gap followers, and I'm certainly one of them, would think that maybe this gap does get engaged, in which case you have to buy with both hands down within the capacity that you have. You get it? I don't think that techs will deliver a crappy quarter, but we do have to watch out for earnings warnings coming out of companies. So if I hear one coming out of any major tech stock, I am not going to be bullish till this downtrend line and this gap is engaged. Am I clear on that?
Yes.
Exactly. That's called being adaptable and flexible on what type of trading that you're doing. So how's you still here? Yes? Okay. I gotta roll this down. Okay, so is that clear on the QQQ? Because this is a very simple chart that I showed. If we break this, if we break, let me clone this line. We break 129 on the, if we break 129 on, why is this doing this? Okay, we break 129.26. You can short the heck out of the Qs and every tech for at least 2 or 3 weeks. Just letting you guys know. That's what real traders do. We look at charts. We don't dictate the markets. We try to predict. In my case, I predict a lot more than I react. And a lot of the other traders react a lot more, and that's fine, whatever they want to do. But I think reactive time in this business is very dangerous now because the machines know when traders are going to react, and that's when they hit them. So on a short-term trade, you can trade it from all the way here to 140, as Jody mentioned, right? And and then it could be another slide down, which would touch the gap. All these dramatics will be played out, in my opinion, over the next couple of weeks. So watch out for the charts. Now, let's take a look at Tesla. And let me take this other quick call. All right, just stay on the line. And I am going to put the daily. And this is in my opinion, a pretty critical chart that we can trade off. Move this down and clone this. Remember, there are traders, very successful traders, and we do it a lot too, who don't care about the directional bias. We just trade the tactical levels. So watch this for 5 minutes. Let me just finish with this call, and I'll be back. Thank you guys for the patience. The White House keeps on calling me because they need to know what my New York Donald boy is going to say out in Europe, all right? So I'm kind of prompting them what they need to say and do. So on that note, is everyone still here? Yes?
Yes.
Yes.
Okay. Because sometimes I don't know if my mic's on my my mic's on mute or not, so that's why I always keep on asking. So we had a monster macro range breakout, which we played very successfully, and that was back not too long ago. Seems like, whoa, years ago. No, it's a little bit more than a month ago, month and a half. Month ago, which was the 30th. You can look at the date down here, the 30th of May. And that was at 325. Remember, we were long in trading Tesla, consistently long, and some quick shorts, which we did well on, and I got burnt on one of them, since 180, 190. And that's, you know, the charts on the Twitter feed, go on the media, scroll down all the way to the date, you're going to see that. So so let's look at what's relevant now, because technical analysis is all about reference point from recent reference point, because, you know, especially on high momentum stocks. So saying all that, we got a big fat gap fill support. There's your minor gap fill right there, and it's almost there. Now, if it breaks through the gap, is there a guarantee it's going to fall into 300? Tesla falls to 300. I am buying heavy. No question about it. Because look what happened here. There's a gap, and that's a major pivot level. And it's a nice 100-point, almost 100-point drop from the 390 level. Now, if you review my tweets and my alerts properly, you will see that I told people to basically sell a good portion of the spike on Monday based on the, what's it called, the Model 5, Model 3. They call it M3. Look, my son is a big shot on the BMW side. He's like, why the heck are they copying the BMW? Why are you calling it M3? That's a copyright infringement, trademark infringement. And M3 is a BMW M3, you know, high performance beast. So why are they calling it M3? Well, Elon called it M3. That's fine. So that's a Model 3, I guess that's what they mean. So that it was close to the highs. Well, that was the close to the highs here, and we played good portions of this move. So bottom line is very simple here. If you think about it, this pattern can, and I believe will, get revisited, in which case it's going to be one of this. Let's say you knew nothing about the stock, but just purely relied on the patterns. That big dome will get revisited because this was where the George Soros's, and I'm sure some of you know who's the biggest short on Tesla from a hedge fund manager perspective.
Einhorn.
Is Einhorn a Tesla short? Okay, who's the I mean, maybe I'm wrong, I don't know, but there is a name that comes out. The guy who's been short Tesla since he was 100, and he is so wrong and he's so bad, but he's got enough money to basically ride the wave. Now he's feeling a little bit good because it's down 90 points from the top. I mean, 60 points from the top. Sorry, 50 points from the top. Jim Chanos. Chanos, C-H-A-N. Google it sometime, okay? The guy is like blah, 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 blah. Except Elon Musk, in defense of Elon Musk, can buy him with one small single paycheck, okay? Jim Chanos has been, he's basically a bear on multiple stocks and the market. But that's what shorts are. But he seems to be very dogmatic short, given the fact that he's been short on Tesla since it was 100 to 200 bucks. So it just behooves me to think, how the hell can he hold on to the stock when it goes to 400? But hey, billionaires are billionaires, okay? Maybe it's a punch of his position that he's down 90% on, and he says, no, it's going to go lower. In the meantime, Google the guy Barron. Not Barron's, but Barron. I forget his first name. Who is one of the biggest bulls on Tesla, one of the richest hedge fund guys out there, with a great track record, by the way. Jim Chanos' track record is not that great. Not on Tesla or on other things. But you know what? Shorts are very dogmatic. They can stick to it. Keep on repeating the same line. So this guy is a plus, this guy is thing. So short term, he's winning. So if this dome happens, what do you think Jim Chanos is going to cover a good bunch of his shorts down here? We're talking another 27 points. I actually want that 27 points to happen within one single day. Guess who else is an idiotic short who got burnt on NVIDIA and blah, blah, blah? Can somebody tell me? Who came on CNBC this afternoon because obviously Tesla was down, so they had to bring him out to make news. No one knows? Andrew left, Citron, the Canadian guy who basically thinks he's a genius and then got burnt on NVIDIA, and he said, no, I covered my short at 95, and he left, okay? So this is what the games that Wall Street plays, except he's not even Wall Street. He sits out there and he's just a hater. Remember, Tesla is all about love and hate. You either love the guy, you know, it's like a sports guy, right? Celebrity. You either love him or you hate him. You love the team or you hate the team. Doesn't matter what they do in the middle. So right now, the climactic sell-off, in my opinion, is probably, despite my little tweet alerts like, okay, buy a little bit here, and we went up nicely right after I tweeted. We went from being down 20 to only down 14. I don't think, I mean, that's the short-term scalp play. I think this gets filled. And that's when you buy really hard. Does it have to be an exact 300? No. Maybe it it gets overdone, falls a little bit lower. But I can assure you, and I'm not going to go into a fundamental analysis on Tesla and stuff like that, that just follow my charts and see what happens. But you get a climactic drop like this, you always get a reflex bounce. So how do you make money in this type of thing? You can make money in spasms. That's a new term I'm going to introduce. What are spasms? Spasms are reflex bounces or actual short-term moves. A spasm is hitting this major breakout level. This was the macro range breakout. This was the gap fill. You could easily get, stock is at 325 after hours. You can easily get a move to 340 or to the upper end of the channel. Right there is 15 points on your money. Play some cheap calls. Now, I can't guide everyone every 5 minutes on these things. That's why I put my charts across. You got to handle your trade because they're fast. There is a gap fill here. Does everyone see it? That's 350. Is it not possible that Tesla jumps up to that gap fill and then comes down hard and creates a W pattern? Absolutely. So get with it. That's why you have to monitor the charts. That's why you have to take some responsibility for yourself. That is called independence. Use me as a resource and be independent on what you trade. Follow other services. Listen to what they say. There's a lot of great ones out there. But no one will be as tactical and as contrarian as I am. And not just on this stock. So this could happen. That will fall again. Don't get excited because it hits towards 350. I'd be selling the heck out of it. We could slip. If this slips, that means there's major, major, major capitulation. A stock doesn't fall from 371 to $371 in one go. Sure, it can happen from here to here. And if that happens, it's a massive bargain, short term. If it happens here, can somebody tell me where the stock would bounce to? Technically speaking. If we hit this, 1 second. I'm just going to show it in pictures. So let's say we zigzag and we hit this. What do you think we're going to bounce to from the 300 level, which is a major support level? Guys, I'm trying to work with you guys. So somebody, look at the visuals. You don't need to be a Tesla specialist to answer this question. Where do you think we bounce to? Look at the visual.
327.
Exactly. Who's that? Jason?
Yep.
Yeah, just visual. I want you guys to be visual traders. Excuse my French. Screw my hardcore technical analysis, whatever. Just look at my charts and trade visually, like you're a frigging trading artist. Okay? Because that's what charts are for. Therefore, visual artists who really make a crap load of money, I still know guys from my old days. I still know some members who said, I just see the patterns in your chart. Some people are no pattern orientated. Just try to keep your emotions to the side while you're trading, and then bring it all out after the market. Drink up. Go out with your friends. Take your wife out or your partner for a dinner, whatever you do. But while you're trading, strive to be robotic. I do. Yeah, there could be crappy times, but be robotic because they will reward you. You're absolutely correct, Jason, and thank you for that answer, Mr. Fox.
Hey, Frank, would you ever straddle this where it is right now? Big moves like this.
Okay, so Brian, new member. I'm already calling you a member because we want to bring you into the fold. So Brian asked me a terrific question when we had our initial conversation, like I do with it. He said, "Do you do straddles have?" This was my answer to him. I said, I look at linear bets when I'm trading, like direct trading. I do straddles and strangles when I'm doing earnings. So in answer to your question, you can certainly, and he said, well, when you put out a thing and you say, 325 or 350, is that a spread or whatever? My answer was, I leave it to the trader to do what they need to do. Because if I put complex iron condors and call spreads and put spreads and stuff like that, not only going to take way out of my time, but more importantly, it's going to confuse the crap out of a lot of regular traders in our group who wouldn't know how to do it, or more importantly, they wouldn't have the ability to do it on a limited account, which is not a day trading account. So in answer to your question, Jason, of course you can. Of course you can. You know what I'm saying? So that you're capitalizing on the move here and a possible short here with in other words, you can do a straddle with a 3-to-1 long bias where you can buy the puts for a limited amount of time, or you calls with a long bias, knowing that this is a substantial bounce from these levels, possible. Or if it drops, you could basically still get some very decent money on your put side, and then you can basically go long on the other side of the picture. So did that answer make sense to you?
Yeah, sure did. Thanks, Frank.
Yeah, so you can certainly do that, sir. Not a problem. Not a problem. I look at it from a linear fashion because this stock is either down or up. Down or up. Like that. So I'm looking at the patterns much more, and of course you can do straddle. In fact, it makes a lot of sense to do it if you really think about it, just in case it slips. Let me just put it this way. Do we really want to bet that hard? Straddles are fine because you always put limited amounts of money against Elon. You think he's just going to sit back and take it? Andrew left, Mr. Citron short, all these guys? No. I personally think that they will deliver the numbers they're saying on their cars, but more importantly, the cars is not the issue. What is Tesla's real growth business? Can somebody tell me? Real growth business. Just the way, I'm going to ask this other question, which I've asked many people before. What is Amazon's real growth business?
Cloud.
Exactly. Cloud, AWS, which 99% of traders have no frigging clue. Okay? The grocery stuff and all that, it's just channels they're opening up to sell more of their stuff. The retail business, that we all buy from, they're losing money on it. What is Tesla losing money on?
Cars.
Thank you.
Cars.
What is their ultimate goal? Where they are starting to, believe me, make a lot and will make a lot going forward. What is it?
Batteries.
And what will the batteries do? Charge my flashlight, or what is it going to do?
Commercial grid storage.
Shit. Excuse my French. Who's the one who answered that question?
It was Jason.
Jason, I'm firing you, man. You're way too smarter than me. You're frigging right. The whole commercial electric grid storage, I am sick and tired of paying my PSE&G bill. I'm really dead. I am. $400 or $500 for what? And we're not even turning the AC on 24/7. We like to keep it within a certain level. The biggest monopoly, the biggest mafia still left in the United States is the utility grid business. Okay? Which Jason just pointed out. Maybe he's part of that mafia, that's why he knows. I mean, seriously. So the bottom line is you're right. So they're attacking that full blast. Yes, it's not something that happens overnight. But think about it for a minute. They've already started installing big batteries in residential houses. I would love to have one of them where I can run all my 12 screens and everything, that's sucking up the energy and save a lot more money. I am sick. I'm seriously sick and tired of paying $400 to $500 on PSE&G bills. Electricity. For what? End of story. So that's what I'm saying. Short term, we can trade it based on the charts. Very clear. Very clear. All right? Longer term, it's a different story. So I'm going to show you one more thing before we sign off. I always get carried away. It's 9 o'clock. So here's a quick one. Here's a sort of background picture of what's going on. Here's your U.S. 10-year Treasury yield. Like I've always taught people, you look at it as this is not 22.1. It's actually 2.2%, right? So all you got to do is move the decimal to the left. So this closed at 2.3334%. You always that's the actual actual interest rate, the nominal 10-year Treasury index. Why is the 10-year bond yield so important? Can somebody tell me?
Because mortgages follow it.
Everything, mortgages, credit cards, any derivative interest rate that we deal with as consumers follows it. You're absolutely correct, sir. Okay, so the bottom line is it's very, very important to the American consumer, given the fact that 70% of the U.S. GDP is consumers, if not more. So the bottom line is consumers care. Car leases, everything. Thank God it's not PSE&G. Then they would be killing us. So I do have a gripe against them. So U.S. GDP is 70% consumers, if not more, 70 to 80%. And so bottom line is this is important. Now let's look at the chart pattern. This is the constructive chart pattern that maximizes the upside somewhere around 2.43 to 2.5%. Anything in this zone, the markets are going to start getting worried, even though historically it means nothing. Nothing. And I'm going to show you that in a second. So bottom line is this move up is very constructive for banks. Banks have more leverage to raise their rates, their loan rates, blah, blah, blah. Underlying capital stress tests all came out fantastic. That's why JP Morgan too, but Goldman Sachs and Bank of America, the ones we play, have done extremely well for us. Bank of America is still a screaming buy, in my opinion. Not because Buffett's in it, but overall picture. They are the most tied in with actual consumer loans. Not Goldman. When was the last time you went to Goldman Sachs to get a consumer loan? I mean, to apply for something. Did you ever go to Goldman and say, hey, listen, I want a credit card? They did start a retail business, but hey, that's just in my opinion. I actually have some friends who are working on that unit. In my opinion, a joke. They call it Marcus. Does anyone know that? Did anyone hear about that? Yes? No?
No,
Okay.
no.
So Google Marcus. I mean Marcus. Guy sitting on friggin', in some small town USA. He's gonna be like, oh, I'm gonna apply for a home loan from Marcus. What is he, some Italian gigolo? I mean, come on. I mean, I don't know who the hell comes up with these brand names, but they call it Marcus. I love it. All right. So Goldman is not in the real consumer type of real baseline mainstream thing. It's Bank of America. That's why I like Bank of America, long term and short term. And the options are dirt cheap. 6 cents to 90 cents, 14 cents to 50 cents. Look at the math. It's like buying a $14 call going to $50. End of story. All right. So just keep an eye on that and keep trading it or holding it, whatever you want to do. So here we have a case of this thing here. This is a constructive chart. It can go as high as 2.63%, where in my opinion, it gets severely overbought. You can see that from the simple internals on the stows, which are extremely bullish, given the wide gap between the parameters on the stow, and just looking at it visually, this wants to go higher, at least to 2.43%, if not the upper end of the middle channel. Now let's take a look at the weekly, which is the longer term charts. This is telling you what? There's first glance, right? First glance. What is, there was the gap, okay? What is this? If you just first glance, forget about, does this chart look like it's going higher or lower?
Higher.
Exactly. Very simple. Same thing with stocks. Look at the stows. Look at the massive, massive bull candle attacking the orange line, which is the 34 SMA, which many of you ACS members know. And we got a short-term top here at slightly above 2.4, which is at 2.43%. Is this good or bad for banks? It's damn good for banks. What is not good for banks, if somebody might like to explain, mention, is over what? Where the markets get very nervous, like, oh my God, rates are going nuts. Which is pretty much going to turn around and hit the banks too. Over what? Quick, it's right there in front of you. You don't need to know any economics, nothing. What is that I'm showing on the upper end that is not going to be good? Because if rates go rampant, it's going to go nuts. Over what?
2.6.
That's it. I'm retired, man. Jason, you're taking over, Seriously, man, I need a break. Yes, you're right. It's so obvious. Now, I want to make one simple example of it. Jason is a smart guy. Yes, I know that. He's a nice guy. It's in his picture. But he's looking at simple stuff. Look at this. It's so simple to see. Look. Boom. Over 2.6. It's like, whoa. What's the market going to do? The market's going to say, whoa, 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 hold on a minute here. Rates are going nuts. Here comes the big one. So we can always draw a line. So what the point that I want to make, like, look at things simplistically. You do not need to be a rocket scientist. I'm certainly not. That's why I call myself clueless. I'm not kidding. All right? This, ladies and gentlemen, is where rates are eventually going to land up 3.2%, which if you look at, and I'll set it up and you can see the big picture. 3% nominal actual 10-year yields are A-okay for everybody, because when yields rise, which is the same thing as interest rates, except they call it yields on government bonds, that means what about the economy? Can somebody step in and answer? When interest rates are rising, is that Good? Or is that a negative indication on the economic health of the United States of America?
That's a positive indication of the economy.
That's right. That means we're healthy. It's almost like saying when you're sick, you don't feel like eating, right? I'm sure everyone can agree with me on that. One of the biggest signs, like the Chinese say, most of our ailments in our bodies come from where? The stomach, right? And the bottom line is, when you feel like eating and devouring food, that means you're healthy. Till you get really, really fat, in which case you're not healthy. But bottom line is, interest rates are the same way. When interests are rising, that means the economy is healthy. It wants to eat. It wants to grow. That's a good thing. Anything above 3% or so, as my charts are showing right in front of you, means we are going to hit a roadblock, because corporate borrowing costs, individual borrowing costs are going to skyrocket. Mortgage rates, which are the pillars of the U.S. economy, housing, are going to get to a point where people are going to say, oh boy, housing prices are going to drop because people are going to refinance less, and the mortgage rates are going to not just creep higher, they're going to jettison higher, over 3.2%. Now, you don't need to really know this about trading, but it helps you if you know it. So the bottom line is, for it to go from here, from 2.3, and here's my next question, to the upper end of the channel, which is 3.1. Remember, you have to move the decimal to the left, is a gain of 800 basis points, and we're at 2.3. Can somebody roughly tell me on a percentage basis how much of a move that is? From here where we closed at to here? If something moves from 2.3 to 3.1, what's a percentage move? Not the actual interest rate. We've already decided that. What's the percentage move? Because that applies to our stock trading too. What's the percentage move? Yeah, who said 35%? House. Hey, you get the A plus on that one. Yes, that's a 35% move. Congratulations, House. You passed your GED finally. All right, that's great. Yes, that's fantastic. Yeah, 35%. You got a 35% move on interest rates. That doesn't mean interest rates are going to go to 35%. This is not like some silly political speech where you're watering down everything to appease the masses, right? This is real economics. You get a 35% move from here to here, you can bet your butt that the markets are going to freak out. That happened back in 2015. It was called the taper tantrum. You know what I'm saying? And the rate tantrum. So we will get another one of these real fast. So I watched this very carefully in the background on behalf of all you guys and for myself, because the bottom line is, if rates moving gradually are totally fine, the markets can handle it. The rates moving rapidly, markets can't handle it. Do you understand what I'm saying? The flip side to that is, when rates move very sharply, what happens to the prices on the government bonds?
They go up.
Just the opposite, sir. You got one wrong. All right? Price is, yes, price is an inverse correlation. Price goes up of a government bond, that means rates are moving down. In other words, there's more of a demand, so rates are falling. Get it? So when rates are rising, that means the price. When rates are rising, price falls. Now, if you have a stock where the price is falling, generally speaking, let's say your margin on the stock, which most bond funds are, by the way. That's why they call it the bond bubble. You've heard that term before, right? the bond bubble, right? So when
Yes.
if we go up 35%, the bond bubble is going to burst in a way which will make the tech bubble look like baby food. It's going to be initially very damaging to stocks, but then the stocks are going to rise big time. So if a stock price falls like Tesla did today, 27.62 on my screen to 325, a lot of people got completely murdered, right? Especially margin sellers, right? I mean, margin people who bought the stock on margin. Yes, correct?
Correct.
Exactly. So the same thing with bonds. When the rates are rising, that means the price is falling. They get margin calls, and that affects them. Lots of funds which own a whole bunch of bonds. They also own stocks. So they sell the stocks on the sidelines in order to come up with the actual margin calls for your stocks. So sometimes you wonder why markets are down when actual 10-year yield is higher. That's because they're getting big time calls, and those funds have to sell other stuff. They have to sell their other holdings, whether it's stocks or high yield bonds, which are just like stocks, in order to come up with the margin call. That is an after effect of an asset class getting blasted. You get it?
Yes.
Same thing with oil. Some traders have asked me, what does oil matter? Well, oil matters because when oil is collapsing, they got to sell other stuff. Okay? They have to sell other stuff which affects your Google, your Apple, your Regeneron, and all the other trading stocks. And you're like, why is that falling? Who cares? They're not involved in oil. Yeah, short term, that pressure pushes down markets. You have to understand the correlations. So just giving you a flavor on that. In the meantime, rates are going higher, which is fine for banks. I think they go to 2.6% before they hit roadblock. I believe Goldman Sachs gets to 230, 240. In my opinion, I've been right on that since 210, 216. Bank of America, I think, goes to 26, 27. That's a lot on those cheap calls. 14-cent calls can go to $1 or more. We've seen that before. And the other and the last 1 second. Let me just clean this out. Like I said, my sessions never go an hour. 1 second. But then I have a great crowd here, so 1 second. Okay, that's a good one. I just want to show you a longer term chart of the market so you guys can go home thinking that tomorrow is not going to be Armageddon unless Kim Il-jung, I always forget his name, the fat man, Korean, that's what I call him, and I love Korean food. We live in New Jersey and the New York area. We have the best Korean restaurants in the world, and I'll tell you, they don't even like that guy. So unless you do something really stupid and we drop a couple of bombs on him, which initially the markets will go down and then they'll climb. This picture of the market is positive. This one that I mentioned before, this pattern that you're seeing right in front of you, and this is all the way from February of this year. Okay, this pattern so far, and I'm going to remove all the lines, clear drawing set. Beautiful. So this pattern right there, and I've mentioned this on my previous ACS that many of you did were in or got the link. 20-day moving average, 34-day moving average, 50-day moving average, and the ultimate, which is the start of a bear market. If we go below that, which is a real bear market, the 150-day moving average, every one of those lines are creeping higher. This particular pattern that you're looking at from a technical standpoint is so far is a bull flag. Means that it can and has the ability and the juice to go higher. Somebody says, well, how much higher? Well, I can show you how much higher right now. You take this. Now, why am I so confident about my technical drawings? Because I've done this for so long and they've been so frigging right that I have to believe my own stuff, all right? I mean, that's a fact. So right there. So up, we are hitting the upper end of the scale, but we could go back and retest the highs at 24.57, which is slightly higher than the previous high on the SPX. This is not the E-minis and stuff you have to convert, but this is the actual S&P 500. Does everyone see this? Because it's all matters on what we're doing on the front side with our trades. So there's your trading range. This so far is still a bull flag, unless we break below this big fat red candle, which from previous week, the week of June 26th. So anywhere below 2400 or 2403 and the 20-day moving average at 2391 is going to be a pullback. Not the end of the world, but a reasonably sharp pullback. All right? So watch my charts. That's the only way you're going to, trade these markets. In the meantime, I'll do my best to show short-term and the swing trades, but you guys have to look on your side in order to manage your trades. So I think that's a fair statement to make on my part. Any questions? No? Yes? Any questions? I'm here to answer, and we'll be closing this in a few minutes, few seconds. Anyone?
The TLT tracks the TNX, right?
Yes, it does. I don't really track the TLT as much, but you are absolutely correct. And the TLT is basically, let's look at the daily. So you're basically looking at the TLT, which is the inverse of the bond ETF, which is the TLT is basically the price of the bonds. You understand what I'm saying? So if rates are going higher, the TLT is going to drop. Now, if you look at the TLT, you can I already discern a pattern. And what do you think that pattern is? And I'm going to draw that in front of you guys. The TLT is the price of the bond, right? So if the rates are going higher, as I explained to you all, the price of the bond is going to fall, right?
Yes.
So basically, if you look at it on a longer term chart, all the way from TLT at 143, which means, when the rates were very low back in July of 2013. Oh, no, what am I saying? July of 2016. This pattern, oh, this is beautiful. Thanks for reminding me. I'm going to show you this very clear. So if one of you want to be technical junkies, watch this real carefully. And who brought up the TLT? Jody?
Yes.
Okay. What do you think happened here? A beautiful gap fill. See that? There you go. It hit the gap fill, and now it's retracing to the lower end of the channel. So this can be construed as a bear flag if it breaks below here, which means rates are going to really shoot high. We do not want the TLT, which is the price of the bonds, to go any lower, which is the ETF, which is basically this is a 20-year bond ETF, to go anywhere below the 150-day moving average, because what is that going to do for rates, Jody? If the price falls that hard on the TLT, what is it going to do for the actual rates or dividend yields on the 20-year bond?
They're going to drop.
Again, you're dead wrong. You get this right in your head. It's an inverse correlation. When price drops, rates rise.
Interest rates, yeah.
Exactly. Interest rates are, as we call, yields for government bonds. So if the rates rise and the price drops, that's not going to be good for the markets. You understand? Below this level.
Okay.
You get it? Because there's going to be way too much pressure for so much money coming out of the bond market. That's what you call the bond bubble burst, right?
Yep.
So anywhere below this, the bond bubble will burst. Short term, it's going to create havoc in the markets. You're going to see Google drop like 30 points for no reason. Okay? Just so you guys understand the dynamics, how it happens, because there's going to be real disruption or disintermediation on the markets, as we would like to talk in the fancy terms back on Wall Street. All right? So you want a gradual move down, not an abrupt crash on the price of the government bonds, in which case that means rates are going to rise real fast, and that money is going to enter the stock market, but initially the stock market is going to basically go like this. Got it?
Okay.
Yeah. So just keep this in mind as I'm posting my alerts and stuff. And the reason for these ACS coaching sessions, just all of you remember, and Brian included, if you're still around, is that just to teach you the reality of what happened, so that when you see my posts and stuff, you at least have an idea. I'm not about just alerts and this and that. It's about an overall education. It takes time to understand that. But you know what? It's not that hard. And that's what I make it to be. So have a great evening, guys. And we shall convene tomorrow. And like I said, spread the word, get your friends in, and good bads, great markets, I mean upside markets or downside markets, we are still doing some fantastic trades. Stay flexible. Do not overload in any one particular position. Trade the charts as I show it and go home happy. Your P&L doesn't have to be green every single day. As long as it's green for the week and for the month, you should be a happy camper. That's what it's all about. So have a great evening. God bless.